Hey everyone, and welcome back to another video for today. So in today's video, I do want to focus only on nebius. We usually talk about nebius, CoreWeave, Iron during the live streams or during other videos out there. But in this one, I just want to focus on this company. Of course, I still own CoreWeave and Iron. I just like nebius way more, which is why it's a bigger position. And I will keep on adding. That's the thing. And this is something that I've said before. This is the name where I have no issues adding more and more. My average is still around $40, so I do have time, right? I do have time to accumulate more shares because we are thankfully much higher than that. Despite still experiencing a drawdown right now of 30%, it was closer to 40% a week or so ago. This is a company worth $24 billion or so. Again, I'm filming this before the Friday market opens, and on Friday, as you know, it's only half a day, probably also very low volume. Now, with nebius, I know, oh, but look at the pricing metrics and all of that. It's very expensive, not profitable yet, depreciation periods, etc., etc. I understand. I'll talk about the things that you need to know when investing in nebius, and I think the same thing goes for CoreWeave and Iron. And so, without further ado, hit all the buttons. We really appreciate that. Fun support me even further. Do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also don't forget Fiscal.ai, previously FinChat, is running a Black Friday Cyber Monday sale until Monday, December 1st, 11:59 p.m. Eastern. You can get 30% off all available plans. Of course, new members will enjoy Fiscal Pro for 2 weeks for free. It's the stock research platform that you see on this channel every single day in every single video. A lot of you love it. A lot of you have already used the link. The link is down in the description and in the pinned comment. Really appreciate that, and just give it a try. All right, so nebius, if we go here and look at the transcript, by the way, very, very easy. You don't have to go to any company's investor relations website. Everything sits right here easily. You click the transcript for the call or the report. If you don't want to read everything, you just hit the AI summary and you get every big number. Now, last quarter, as you know, was again a pretty good one. Last quarter, group revenue reached $146.1 million, up 355% year over year. The growth rates here, of course, are incredible, but then again, that's normal when you start from a very, very small base. It was also up 39% quarter over quarter. Now, the big thing last quarter was them increasing the ARR for 2026, or, well, yes, I'll explain that as well, because for those that are not familiar, you might think that next year is already going to be a monster year, which is true, but you need the added info. And so looking at the letter to investors, they see the following thing. $7 to $9 billion expected annualized run rate revenue at the end of 2026. Now, how do they reach that number? It's basically taking the last month of the quarter and you're multiplying that by 12. We'll do some quick maths in just a bit. Then, contracted power at the end of calendar year 2026. Previously, they told us for contracted power, not connected, contracted, not active either, 1 gigawatt was previously announced. Last quarter, they told us over 2.5 gigawatts. That's the plan. And if that's the plan right now, and they can grow faster, I do think that this will be achieved and surpassed. Now, as for connected power, calendar year 24, they only had 25 megawatts. Calendar year 25 ending, 220 megawatts. Calendar year 2026 ending between 800 and 1 gigawatts. That's the plan for connected power. For the quarter, they sold out all available capacity. They had 19% adjusted EBITDA margin. Group revenue, as we said, increased quite a lot year over year and quarter over quarter. Core AI infrastructure business did grow faster than overall, 400% year over year and 40% quarter over quarter, and $4.3 billion of funding was secured in September. Now, they also told us the following thing. In September, we also announced our first large enterprise AI infrastructure win with Microsoft, valued between $17.4 and $19.4 billion. We are fully on track with the execution of this contract and expect revenue from this deal to start ramping up throughout 2026. They've also announced a second large AI infrastructure deal, this time with Meta. Their agreement with Meta is valued at approximately $3 billion with a 5-year term. Over the next 3 months, they plan to deploy the capacity needed to service the agreement. In fact, demand for this capacity was overwhelming, and the size of the contract was limited to the amount of capacity that they had available. So if they had more, it would have been much more than just $3 billion. And similar to the Microsoft deal, the economics of this agreement are attractive and will help accelerate the growth of the AI cloud business even further in 2026 and beyond. Remember, before they announced the Microsoft deal, they already talked and hinted towards getting huge deals. And even after the Microsoft deal, they said this is the first, but definitely not the last one. Didn't really take that long until we got another huge player. In this case, that's Meta. But remember, they're not only going after hyperscalers. They want to go after enterprises. They want to go after AI labs. That's also a huge market. Then, last quarter, as we've just read, they guided for 1 gigawatts of contracted power by the end of 2026. They're currently in the process of securing additional sites that would bring their total contracted power to approximately 2.5 gigawatts by the end of 2026. Again, connected power is different than contracted power. Of this contracted amount, they expect 800 megawatts to a gigawatt of connected power. And connected power equals GPUs that can start generating revenues for the company. Now, if we start doing some quick maths, we did this in the last video as well. 1 billion in ARR, that was the guidance, that still is the guidance for this year. And again, ARR is taking the last month and multiplying that by 12. So if we just do the reverse, it's $83.3 million per month or $250 million per quarter. Then for next year, right, the next year ARR, that's midpoint $8 billion. Here again, we do the same thing. We get this scary, dangerous number here, $666.6 million per month or $2 billion per quarter. Just a friendly reminder that we're going from right now $146.5 million per quarter to then potentially, well, in my estimate, to reach the full year 2025 revenue guidance is 525. So to reach that, you just look at Q1, Q2, Q3, and then, well, we just have to add another $218 million or so to reach this number right here. But look at how fast this thing is growing. $250 million per quarter. And then, a year later, expected to be at a $2 billion per quarter run rate. And of course, this number is only because we're looking at the last month multiplying that by 12. But every month after that, the base number gets bigger and bigger and bigger. And so, to simplify things a little bit, let's take $25 billion in market cap. Full year 25, $1 billion in ARR, which is them basically saying $1 billion 2026. But it's going to be more in 2026 since, again, we're taking the last month, multiplying that by 12. But in January, February, March, that number will keep on growing. But okay, to simplify things, $1 billion in ARR. So you're talking here about 25 times fiscal year 25 ARR. Okay, then in fiscal year 26, midpoint is $8 billion. Again, the multiples here, the pricing metrics, are not that crazy. What is it, 3.5 or 3 point something times fiscal year 26 ARR for this company that's expected to grow this quickly? I'm saying here $14 billion for fiscal year 27. I think it's achievable. So we're not even paying 2 times fiscal year 27 ARR. It's not that crazy. People think that, oh, it's already too expensive, extremely overvalued. But no, if they execute, if they manage to grow rapidly, then these numbers are very much achievable. Then, if you just look at revenue, 2025 sales, 525, that's the number, I think. Then, for 26, Those are the numbers floating around from analysts. Again, not that many analysts. For more analysts cover this company today than they were a couple of months ago, but that's $3 to $3.5 billion or so, I would say. And so 2026 sales, we're not even talking here about 10 times forward sales, which is also not that crazy. Then as for 2027, I'm putting here a number around $8 billion in sales, not ARR, sales. So yeah, what is it, 3 times? It's not a lot, of course, like I said, there are things that you need to know. We'll go back to what I just skipped on right now. Things that you need to know, that this is a CapEx heavy business. We know this, right? The majority of the CapEx goes towards GPUs. Then the other big chunk goes towards, well, building a data center. And only a small portion of the CapEx goes towards land and energy. So yes, it is CapEx heavy business, still not generating billions of dollars in cash. So yes, dilution is going to happen, is probably happening right now. You need to know that. But if it's dilution in order for them to become a huge $100 billion plus company, me as a long-term shareholder, I'll be fine with that. How fast can they grow equals how much money they can make, right? As we've seen with the Meta contract, if they could have offered more, Meta would have paid more, but they don't have the capacity. In order for them to have the capacity, they'll need to move faster. In order for them to move faster, they'll need to raise money, and well, yes, dilution is going to happen. Then you also need to know a couple of other things, 2 things here. One, macro, right? Macro sentiment can hurt a stock like that. Macro sentiment can maybe hurt the way this company is going to raise cash. It's possible. And then let's be realistic. Now you're going to say, oh, you're saying be realistic, but then you talk about these types of numbers right here. Yeah, but these types of numbers are not, most of them are not numbers that I'm making up. Most of them are numbers that the company gave us. And then yes, for 27, I am making up or making some educated guesses. That's true, but that's what most investors do. And we try to be as close as possible to what's going to happen in the future. I could have said, oh, we are going to be at $20 billion in ARR and then 12 billion or 14 billions in sales. But no, I'm keeping it in my eyes realistic. And even if it is lower, even if it is $12 billion ARR in fiscal year 27 and only, let's say, $6 billion in sales, it's still not a lot when you put that multiple on those numbers. Still not a lot. Now, I think 2 quarters or so ago in Q1, they told us the following thing. They are anticipating 20 to 30% EBIT margins in the medium term, which is in a couple of years, driven by 3 factors. Scale and utilization, achieving significant scale in the AI cloud business. As the business grows, a greater mix of workloads, training, and inference allows them to run their GPU fleet with high utilization for longer periods and, of course, in a very, very efficient way. Second, a greater contribution from high-margin software and services revenue, like their AI Studio platform and Aether Enterprise tools. Of course, also announced the Token Factory not that long ago. And then 3, the shift of workloads towards inference, running trained models for users, is generally a high-margin activity than raw training compute. Looking longer term, management is confident that the continued scaling and expansion could lead to scenarios where margins potentially exceed 30%. I don't know why there is a dollar sign here, but it's 30%. And then, of course, we need to talk about the, depreciation aspect of all of it. So, Nebius' conservative accounting policy intentionally depresses reported margins in the short term, giving the company a hidden advantage. So 1, Nebius applies a conservative 4-year depreciation schedule for its assets, the GPUs. In contrast, most competitors, particularly the large hyperscalers and, yes, CoreWeave, use a 5 or 6-year depreciation schedule. Now, depreciation is an expense by spreading the cost of a GPU over a shorter period, in Nebius' case 4 years. Nebius recognizes a higher expense today, which lowers reported margins relative to competitors. Now, of course, by doing so, they reduce the risk of future impairment charges if the asset's economic value drops faster than its accounting life. And if not, then they benefit from that as well. And I would also like to remind you that I am only, right, in this video, I'm only talking about Nebius's core business. I'm not talking here about a VRite, I'm not talking here about 1010, Toloka, or a ClickHouse and the value that that adds to the whole investment thesis, the value that that adds to the, well, valuation of this whole company. Because Toloka, although they're not reporting Toloka anymore because they're not the majority shareholder, same with ClickHouse. Last time they got I think we've got the reported number, 28% stake in that company. I don't know if it's that big anymore, but ClickHouse is, in my opinion, going to be a huge company that is probably going to go public over the next couple of years. That's going to be one way for Nebius to raise capital. A VRite is also growing quite rapidly. There might be a moment where, yes, Nebius does raise capital through a VRite as well. But I'm not even talking about that. I'm purely talking here about the core AI infrastructure, AI cloud business. To me, all the rest is going to be on top, right? That cherry on top of your dame blanche or whatever you want to call it. And so right now, when you look at the stock, we can see that over the past month or so, the stock has been battling here with the 100-day moving average. Yes, it did close that gap a little bit, maybe by almost half, right? That gap from that Microsoft deal. It did need to go another 14% lower to completely close it out, to be at $66 or so. To me, as long as we stay under 100, I will keep accumulating more shares. And if we do go back above $100, that's not going to stop me accumulating more shares, but I might not be as aggressive as I would be under 100, maybe under 90 as well. Because if this company truly succeeds, because I remember when Manuel had a conversation with Roman, and they talked specifically about NVIDIA Lepton, right? People are saying, oh, NVIDIA Lepton is going to be a threat to companies like Nebius, etc., etc. But it was in that context where Roman basically said, look, the risk here is us not executing, us not delivering. It's not someone else. It's if Nebius fails at executing and delivering the goods, that's going to be on them, and that's going to be the reason why it's going to fail. Me personally, one of the main reasons why I am way more bullish on Nebius than any other company in that market is because of the execution and is because of that team. Some people don't like it, that those are previous Yandex engineers and stuff like that, but I think it's their huge advantage here. So all in all, that's about it. I do still think that this is going to be a monster stock for the future. I think at $25 or so billion right now, if you look at that company 5 years, 10 years from now, it's going to be a joke. It's going to be so much bigger than what it is today. But of course, along the way, we might see some pullbacks here and there. And yes, continued execution is key to their success. So all in all, that's about it for me in this video. Hope you enjoyed. See you all in the next one. Check out fiscal.ai to get 30% off. That promotion runs up until Monday night. Thank you. Have a good weekend.